A gloomy economic assessment from Fed Chairman Ben Bernanke sent stocks around the world lower yesterday. And our next guest is not in the double dip camp, but says the markets could continue their sell-off. Christopher Lowe is the chief economist at FTN Financial. He is in the newsroom with us today. Chris, thanks so much for coming in. Bernanke, as Scarlett was just talking about, saying economic growth somewhat slower than expected, highlighted the issues, the uneven recovery, troubled labor markets. We used some pretty strong terms. What was the most important part of his language to you?
To me, I think the most important thing was when he said monetary policy is no panacea. People are looking for hints about QE3. In fact, have been looking for them since we had that round of weak data last week. But so far, anyway, it's not coming.
Do you think, though, this drumbeat of economic data that we've seen, especially last week, and the jobs report really capped it off, is showing the economy is running out of steam? I mean, what do you make of this lack of a QE3 hint?
Yeah, well, it is running out of steam. But the culprits are right now that there's significant Japanese supply issues after the earthquake. So that's part of it.
But that will go away eventually,
exactly.
Right?
But the other big thing, which is actually really the primary cause of the slowdown, is higher gas prices, higher food prices. Those follow from overheating in the emerging markets. And the answer to that is emerging market policy, not U.S. monetary policy. And thankfully, all of the big emerging market economies are already tightening.
So reinvesting maturing bonds, that strategy is the one that's just going to have to continue to work.
Absolutely. Part of the issue, if you look at what QE2 has accomplished, we obviously have lower yields. That part's great. We have a higher stock market.
Under 3%.
Yeah,
right.
And that's good too. But we also have a significantly weaker dollar, and there's no question, whether the Fed caused it directly or indirectly by through investor fears of printing money and that kind of thing.
The Fed has taken so much criticism as it is for QE2. So I mean, you have to wonder, would QE3 even work?
Well, that's exactly right. If you look at oil prices, for example, since the end of September in the U.S., oil is up 20% in dollars. In euros, it's up 10%. So half of the increase is because of the drop in the value of the dollar, which directly or indirectly you can tie to Fed policy. So easy policy helps in the sense that we do have lower rates. But when you look at consumer spending, consumers are spending more dollars. They're getting less stuff because the dollar's lost value.
So if we had QE3, some form of it, QE2 light, I don't know what to call it, I mean, what would happen to inflation?
Well, that's the real issue. We've seen inflation already accelerate, both headline and core. The core, in fact, from 0.6% to almost 1.5%. So a pretty significant rise there. And that is obviously not attributable to food and energy because it is core prices. I would expect that we'd see an even faster acceleration if the Fed did a third round of bond purchases. And that's probably what's holding them back.
That's probably what's holding them back. Jamie Dimon asking Bernanke if regulators have gone too far, banks are not lending, DoddFrank still not in place. How much of this is arguably weighing on the economy?
Well, it is a significant factor. I was actually down at the Tennessee Bankers annual in Florida on Monday speaking, and I talked to a lot of community bankers. They're actually less affected by Dodd-Frank than the big banks like J.P. Morgan. Nonetheless, every one of the CEOs I talked to said his biggest expense increase this year relative to last year is paying people to interpret that rule. Dodd-Frank is a burden for banks of all sizes. And there's no doubt in my mind when you look at tightening credit conditions now, they should be easing. But it is because we have these new regulations coming in.
It's just putting added pressure on a system that seems already stretched. Chris, thank you very much. Chris Lowe, chief economist at FTN Financial.